Hello and welcome back. In this presentation, we will build on our understanding of job order costing to explore some more advanced and more realistic applications. We'll move from accuracy to profitability, mastering costing techniques for strategic decision-making. Today, we'll start by looking at the accuracy problem and why the choice of an allocation base is so critical. Then, we'll explore a better way to achieve precision by using multiple departmental overhead rates. We will walk through a detailed case study for the Dixon Company to see how to calculate a job's cost and set its price. After that, we will bridge the gap to financial accounting by seeing how these job costs flow into the income statement and balance sheet. Finally, we'll touch on some advanced topics, including how to handle under or over-applied overhead and get a brief look at an even more precise method called activity-based costing. So, why are we so focused on accuracy? Let's use a simple pizza analogy to illustrate the point. Imagine you and 3 friends order a large pizza for $20, which is cut into 10 slices. One friend eats 5 slices, 2 others eat 2 slices each, and you only have 1. How should you split the $20 bill? If you use number of people as your allocation base, everyone pays $5. You'd pay $5 for a single slice, which doesn't seem very fair. A more accurate method would be to use number of slices eaten as the allocation base, which is the true driver of the cost. In this case, each slice costs $2, and you would accurately pay $2 for your share. The key takeaway is that using a poor allocation base distorts costs, and to get costing right, the base you choose must actually drive the cost you are trying to allocate. The pizza analogy shows us that a single, simple allocation method can be misleading. In a business context, a single plant-wide overhead rate can be inaccurate, especially when a company has very different departments. A much more accurate method is to use a separate, unique overhead rate for each department. To see this in action, we'll look at the Dixon Company. Dixon has 2 production departments, milling and assembly. These departments have different cost drivers. Milling is machine-intensive, so it's logical to apply its overhead based on machine hours. Assembly, on the other hand, is labor-intensive, so its overhead is applied based on direct labor hours. It's also important to note that Dixon uses a cost-plus pricing strategy, where they determine a selling price by adding a 75% markup to a job's total manufacturing cost. Now let's get into the calculations for Dixon Company. The first step is to estimate the total manufacturing overhead, or MOH, for each department. For the milling department, we add its fixed overhead of $390,000 to its variable overhead, which is $2 per machine hour times the estimated 60,000 machine hours. This gives us a total estimated MOH of $510,000 for milling. For assembly, we add its $500,000 of fixed overhead to its variable component, which is $3.75 per direct labor hour times 80,000 hours, giving us a total estimated MOH of $800,000. Step 2 is to calculate the predetermined overhead rate for each department. For the milling department, we divide its estimated overhead of $510,000 by the estimated 60,000 machine hours to get a rate of $8.5 per machine hour. For the assembly department, we divide its $800,000 of estimated overhead by the estimated 80,000 direct labor hours, which gives us a rate of $10 per direct labor hour. With our departmental rates calculated, we can now apply overhead to a specific job. For job 407, we need to look at the actual hours consumed in each department. In the milling department, job 407 used 90 machine hours. We multiply this by our milling rate of $8.5 per machine hour to get $765 of applied overhead from that department. In the assembly department, The job used 20 direct labor hours. We multiply this by our assembly rate of $10 per direct labor hour to get $200 of applied overhead. To find the total overhead for job 407, we simply add the amounts from both departments. $765 from milling plus $200 from assembly gives us a total of $965 in manufacturing overhead applied to this job. Now we can finalize the cost and set a price for job 407. Step 4 is to calculate the total job cost. We sum the three cost components. Direct materials for the job were $1,170. Direct labor was $350, and the manufacturing overhead we just applied was $965. Adding these three together gives us a total cost for job 407 of $2,485. Step 5 is to calculate the selling price using the company's 75% markup policy. We multiply the total cost of $2,485 by 75% to get a markup of $1,863.75. We then add this markup to the cost to arrive at a final selling price of $4,348.75. The system we've just used relies on estimates. So, what happens when our estimates aren't perfect? In the real world, the amount of overhead applied to all jobs during a period will almost never be exactly equal to the actual overhead costs the company incurred. This creates one of two situations. If the applied overhead is less than the actual overhead, we have what's called underapplied overhead. This difference must be accounted for by increasing the cost of goods sold, which in turn lowers net income. Conversely, if the applied overhead is more than the actual overhead, we have over-applied overhead. This will decrease the cost of goods sold and increase net income. The key takeaway is that the cost of goods sold on a company's income statement must be adjusted at the end of the period to account for any under or over-applied overhead. While using departmental rates is a significant improvement over a single plant-wide rate, we can push for even greater accuracy. What if a single department performs many different kinds of activities? This leads us to a more advanced approach called activity-based costing, or ABC. ABC creates separate overhead rates related to the specific activities performed within departments, which can result in even more accurate job costs. A great example of this thinking in the business world is on-demand manufacturing. A company called Resonance Companies Inc. produces clothing for designers and uses QR codes to track every input for each specific item, the fabric, the water, the labor, which allows for highly accurate item-level job costing. Let's summarize what we've learned. First, accuracy is key. The choice of an allocation base has a dramatic effect on job cost accuracy and can be the difference between a real and an illusory profit. Second, multiple rates are better. For companies with diverse operations, using departmental overhead rates provides a far more accurate cost than a single plant-wide rate. And finally, this accuracy provides pricing power. Accurate job costing is the essential foundation for effective strategies like cost-plus pricing and for conducting meaningful profitability analysis.